Hi there, my name is Rebecca Rowe and I am an independent business consultant. Today I will be presenting my appraisal findings on the company Metal Masters Limited to their management team. Metal Masters Limited, or MEML, is a producer of specialised sheet metal machinery and products. The company was founded by partnership in 1990 and was then incorporated in 1995. MEML's custom design and metal forming machines are franchised to heating and metalwork contractors. This appraisal can be used to inform the management team of MEML on the financial and non-financial issues of the company as they approach the 2021 audit. This presentation will address the 5 potential problem areas of MEML, including quality control, accounting for warranty claims, debt burden and ramifications, potential auditing issues, and other miscellaneous issues. Quality control problems. MEML has adopted a unique form of sheet metal manufacturing, making their product more high technology and complicated than the standard sheet metal process. Quality control is at the heart of the organisation's focus, as MEML strives to maintain a zero-defect approach. Although, due to the use of the unique technology, there are 3 factors that threaten the quality control of MEML. Firstly, when dealing with unique products that have varying components, the likelihood of production errors and quality problems typically increases. MEML has pursued strong actions towards implementing an inspection process, both for jobs in progress and machinery operations. This is the best way for MEML to verify the quality of the produced sheet metal products and machinery. A further suggestion would be to implement a quality control checklist which consists of a table of the critical components. During the inspection, the inspector can check against the product machinery. This documentation will assist machinery staff in clarifying the quality requirements. Secondly, managing the different franchises of MEML can pose quality control problems. Although the market for MEML's processes and products expanded through contracting to franchise dealers, this consequently limited the transparency of the brand. MEML does not have the same control over their products and processes as if they were to sell them themselves. But through audit and factory inspection of the representatives, MEML can maintain their quality. Finally, quality control becomes a problem when there is a lack of understanding of the functioning and requirements of the product and its machinery. The need for sufficient worker training has been acknowledged by MEML as they recognise the unique characteristics that their product and processes hold. Training is only led by employees that have been proven to successfully operate the machinery. It is recommended that MEML consider introducing a refresher training course for machinery workers. This course could be required to be completed on an annual basis to ensure that operators continue to meet company requirements. As the company has now been operating for a number of years and has had long-standing employees, it cannot be assumed that all of these employees are up to date with operating standards. Accounting for warranty claims. MEML has a strong history of low warranty claims, and to completely replace a sheet metal installation is very expensive, and prior to 2020 has only been done once in the company's history. In the financial statements, it illustrates that warranty claims have been recorded as administrative expenses. Although this does not represent that in fact management charges the warranty costs against inspection and warranty fee revenue. In the past, due to the low claim on warranties, there is no need to record a warranty liability. As previously, it has not been probable that the warranty expense will occur. Now in 2020, 3 separate replacements have had to be made under warranty, which was subsequently recorded as a warranty expense for the period. This has significantly impacted the profit of MEML for the 2020 financial year, as is shown by the loss of $702,000. Going forward, it is recommended that MEML implements a historical warranty percentage as a base for determining an estimate of annual warranty expenses. This can be used to determine the estimated level of warranty expenses based on the level of sales for the period. Therefore, in future periods to come, MEML's income statement will be impacted by the full amount of warranty expense when a sale was recorded, even if there is no warranty claims in that period. The warranty expense account will be accrued by a debit to the warranty expense account and a credit to a new warranty liability account, as shown in the entry below. As the claims appear in later periods, based off the previous period's sales, the impact lies on the balance sheet, where the warranty liability and inventory accounts will be reduced. Debt burden and its ramifications. Looking towards the current debt situation of MML, in the 2020 financial year, the company undertook a situation of ownership restructuring. Due to the unfortunate death of Director Ken, the company actioned the agreement to purchase Ken's shareholding from his widow. MML financed $900,000 of the shareholding to support Jeanette and Peter in their ownership proportions, illustrated through a fixed asset in the statement of financial position as a loan for shareholders. This consequently created a debt burden for the company, where the $900,000 was advanced through an increase in the loan from shareholders by 68% and long-term debt from the bank. Displayed in the debt service coverage ratio, MML in 2020 is not generating sufficient operating income to cover its annual debt and interest payments because the ratio is less than 1. This is disappointing for the company, given that they had a strong debt service coverage ratio prior to this in 2019 and 2018, as it was above 2. Despite this, the debt ratio showed a positive increase in 2020, illustrating that a significant portion of the debt is funded by assets. This means that, although it may appear that the company is experiencing a high amount of debt pressure, which is subsequently shown through the debt to equity ratio dramatically increasing in 2020, this is not to be of a worry, as a significant portion of the debt is funded by assets, which is the loan to shareholders which was advanced by MML. It is to be noted that in 2020, MML did not have a short-term bank loan, which is promising for the short-term liquidity position of the company. Potential auditing issues. The 2020 financial year resulted in a loss for MML, who prior had been reporting strong profits. In the upcoming audit, the going concern of the company will need to be assessed. This is a concern that has only arisen as a result of the economic loss and would not have been thoroughly considered in previous audits. This appraisal will act in support of the 2021 audit by MML by assisting the auditor to better understand the entity and discover the areas that require specific audit attention. It was noted that certain employees at MML have been with the company from the beginning. Management is said to have full trust in these employees' judgment. The levels of authority that these employees hold still needs to be controlled, and it needs to be considered by the auditors that these staff members may abuse the level trust for potential personal gain. The level of authority that these long-term employees hold needs to be assessed. It also needs to be checked that sufficient internal controls, including segregation of duties, is enforced, and that all employees' work is regularly reviewed and reconciled. Due to the unfortunate death of CEO Ken, his 50% holding in the shares of MML were valued at $1.1 million. This poses a further auditing issue, as it needs to be ascertained that the business valuator is an independent third party, so that from an auditing perspective, it can be confirmed that the valuation is legitimate and fairly represented, as this could potentially threaten the chance of assets being overstated. MML incurred a dramatic increase in liabilities for 2020 due to the advancement of the loan for share purchases. Hence, this runs the audit risk of the understatement of liabilities. In the upcoming audit, the liability balances need to be confirmed, for instance through bank confirmations. It is more likely that as a result of the loss suffered by the company, a situation of fraudulent manipulation will occur in order to increase the company's earnings in the coming period. Other miscellaneous issues. Beyond the discussed areas, there are also numerous other aspects of MML's operations that should be considered. Firstly, MML reports that each job site is inspected at least twice a year, at least twice during the metalwork phase, and equipment is inspected at least twice a year. although MML needs to consider implementing a set required number of inspections that need to occur in order to ensure consistency. This is because, potentially, if inspector employees can get away with only inspecting twice a year, they may not go to the efforts to inspect beyond those 2 times. Importantly, as a company, MML needs to place a strong emphasis on ensuring that comprehensive credit checks are completed on all franchisees. After it was found that one of MML's franchises was a fraud, resulting in a significant burden on the company, resources need to not be scarce towards ensuring the legitimacy of their customers before approval of the franchisees. It is notable that the accounts receivable balance of MML in the last 2 years has increased significantly. As was discussed with regards to the debt burden, the solvency position of the company is very weak. In order to recover the solvency position of the company, it is recommended that MML emphasises collecting outstanding accounts receivables so that its turnover is efficient as possible, which will improve MML's balance sheet, ultimately providing a better cash position to reduce liabilities. It is notable that over 2019 and 2020, the accounts receivable balance has dramatically increased. MML could opt to implement a discounted price in exchange for immediate payment. MML's new ownership structure means that Jeanette Brown, who has been with the company since 2015, will hold a 30% ownership in the company. When Jeanette joined, she faced discrimination from market staff for being a woman in leadership. As MML's employee base is largely long-standing employees, it needs to be considered whether these past prejudices are still present and may become voiced as Jeanette holds a greater standing in the company. In conclusion, the 2 key elements during 2020 of the unprecedented warranty claim and the shareholder ownership restructuring significantly impacted the financial position of MML. The uniqueness of MML's products and machinery threatens the company's quality control. The previous method of accounting for warranty claims will not be sufficient moving forward from the large 2020 claims. Due to the restructuring of shareholders, the company was placed under large debt, although it is to be acknowledged that an acceptable portion of this is funded by assets. From an auditing perspective, MML is vulnerable to fraudulent manipulation in order to falsify recovery from the losses of 2020. After assessing the financial and non-financial position of MML, I present the following recommendations to management. Implement a quality control checklist, which consists of a table of the critical components to be observed during inspections. Introduce an annual refresher training course for machine operators to ensure they meet company requirements. Implement a historical warranty percentage as a base for determining an estimate of annual warranty expenses, which will be accrued as a warranty liability. Ensure adequate controls are enforced on employees to mitigate any potential fraudulent activity, either for personal gain or to recover the losses of the company. Ensure comprehensive credit checks are completed on all franchisees, and implement a discounted price in exchange for immediate payment on all transactions in order to increase cash flow to ultimately pay off the debts of the company. Thank you for your consideration of the financial and non-financial problems and recommendations of Metal Masters Limited.